Welcome to the ProTicker Deep Dive. Today, we are jumping into really the phenomenon driving the equity market, the Magnificent Seven. We're talking Apple, Microsoft, Amazon, Alphabet, Meta, NVIDIA, and Tesla. They're the engine, right? Behind this huge market bet on artificial intelligence. So our mission today is pretty focused. We want to unpack the hype, look at the numbers, the history, and really try to answer this one big question for you. Have these seven companies just become too important, too big for their own good, maybe even for ours?
And that's such a critical question right now because the scale we're seeing, it's just immense. I mean, collectively, the Mag 7, they've hit a market cap around $22 trillion. Massive. And get this, they count for over one-third of the S&P 500's returns. But the narrative out there, this idea that, AI equals free money, that's where it gets dangerous. It's really not that simple.
Right, and that's the core tension, isn't it? On one side, okay, these aren't the tech companies from 2000. They have real revenues, strong competitive advantages, moats, as they say, and they're making serious profits.
Exactly. Real money, actual earnings. That's a fundamental difference. But, and this is a big but, despite that strength, the way they're spending on AI right now, this huge capital spending cycle, it's starting to look a lot like past infrastructure booms.
Like the railroads back in the 1880s.
Yeah.
Or maybe the telecom fiber build-out in the late 90s.
Precisely those examples. Those booms absolutely changed the economy, no question. But for the companies building the infrastructure, often the shareholder returns ended up being pretty disappointing in the long run.
Okay, let's dig into that concentration first, the sheer size. When we say too concentrated, what does that actually look like today? Can you put a number on it?
We absolutely can. So as of October 2025, these seven stocks made up, get ready for this, 37.4% of the S&P 500's total market value.
37.4%. Wow.
Yeah, and why that number matters so much is history. It's the first time ever recorded that concentration has gone above 37%.
Okay.
It basically means the entire market's performance is really leaning heavily on just this handful of companies.
That number, 37.4%, immediately makes you think tech bubble, right? Back to 2000. But when you dig into the sources, the comparison, it doesn't quite fit, does it? What's the key difference in pricing?
Well, the aha moment is really in the price to earnings multiples, the PE ratios. Back in 2000, the top 10 biggest companies, they were trading at something like 43 times earnings compared to the rest of the market. Just astronomical.
43x. Okay. And today?
Today, the Mag 7 trade around, say, 31 times earnings. The rest of the market, about 21 times.
So still a premium, definitely not cheap.
Oh, absolutely a premium. But, and this is crucial, it's a premium backed by significant actual earnings. They are comparatively better bargains than those 2000 giants were.
So the insight isn't that they're cheap, it's that they're profitable, genuinely profitable. That gives them a safety net that dot-com companies just didn't have.
Exactly right. The fundamentals are there. They're solid.
But if the valuation itself isn't the bubble, what was the trigger? What pushed this concentration risk to this record level?
It really comes down to one thing. The generative AI inflection point. That happened in 2023.
ChatGPT.
That's the one. When ChatGPT came out, Wall Street didn't just see it as, another tech improvement. They saw it as a fundamental shift, something on the scale of the internet's emergence.
And that belief triggered the spending spree.
It kicked off this historic multi-trillion-dollar capital investment cycle that we're now trying to get our heads around.
Okay, so this is where the story gets really interesting, I think. The infrastructure investment. These tech giants, known for being asset-light, are now basically becoming the infrastructure providers for this whole AI revolution.
Yeah.
What does that spending, the CapEx, actually look like in terms of dollars?
Astronomical is probably the right word. CapEx, just to clarify for everyone, is the money spent on physical things, data centers, servers, chips. And by 2025, the five biggest cloud players, they've committed to investing roughly $400 billion annually.
$400 billion every single year.
Every single year, just on data centers and AI hardware. And that's just the near term. There are projections, Goldman Sachs, I believe, estimating that the cumulative AI infrastructure spend could hit $4 trillion by 2030.
$4 trillion cumulative. That just validates this idea that companies everywhere are scrambling for computing power.
It does, and you see it flowing through to the results of the companies selling the gear and the services.
Yeah, the revenue numbers must be showing it.
Absolutely. Look at NVIDIA. Their data center revenue surged, 56% in Q2 2025. Microsoft Azure, up 34%. Alphabet's cloud grew 40%. Even Amazon's AWS reaccelerated to 20% growth.
So it's not just hype. The CapEx is turning into real sales. Real revenue velocity.
It is. The spending is translating into commercial reality right now.
But here comes the risk again. This massive shift to being asset-heavy. These companies became giants partly because they're asset-light, high-margin software businesses generating tons of free cash flow. Now they're building data centers like utility companies. Is the market okay with that shift?
That's the core risk everyone's grappling with. They're taking that cash flow and plowing it into physical infrastructure, moving from software models to these asset-heavy infrastructure plays. And historically, that kind of transition tends to squeeze returns over time.
Why? Because of competition? Higher costs?
Both. Asset-heavy businesses generally face more competition eventually, and they have much higher fixed costs. It changes the financial profile significantly.
We saw that reaction when Meta guided to over $100 billion in AI capex for next year. The stock definitely took a hit.
It certainly sent a chill through the market. It suggests investors are, at the very least, cautious about this. Think about it. Microsoft, Meta, Alphabet, they're projected to spend maybe 21% to 35% of their revenue on capex.
That sounds incredibly high for tech companies.
It is. It's getting close to what a typical global utility company spends. So investors start asking, rightly, what does this do to margins long term? These used to be companies known for buybacks. Now they're spending like utilities on buildings and cooling systems.
Okay, but this group, the Mag 7, they aren't all the same. They're not a monolith. We have to look at who's actually executing well in this AI race, right? Because there's divergence.
Huge divergence. You saw it clearly in the Q3 2025 earnings. Overall, the group had strong earnings growth, about 26.7%. But individually, very different stories. You had clear winners. Amazon's AWS accelerated back to 20% growth. Alphabet delivered, I think, 33% earnings growth. Really strong cloud performance there.
But then you had the laggards, which serve as warnings.
Big warnings. Tesla's earnings dropped sharply, like 39%. A reminder that not all tech bets pay off, especially in rapidly changing sectors. And look at Apple. Relative to the AI infrastructure build-out, Apple only returned about 21% over the last 12 months.
Which sounds good in isolation, but compared to NVIDIA.
Exactly. NVIDIA delivered an explosive 52% return in the same period. NVIDIA, now with a market cap over $5 trillion, is just completely leading this infrastructure charge.
NVIDIA seems untouchable right now. They're selling the picks and shovels to everyone in this AI gold rush. But is that dominance being challenged? Is it sustainable?
It's absolutely being challenged. The competition is ramping up and fast. You've got Broadcom landing a big partnership with OpenAI. Google's pushing its own custom AI chips, their TPUs, tensor processing units more aggressively to cloud customers.
They're designing their own silicon.
They are. Trying to reduce that dependency on NVIDIA.
And that competition makes NVIDIA's valuation look even more precarious, doesn't it?
It really does. That PE ratio, around 58, 59, it leaves absolutely zero room for error. Any execution misstep, any sign that competition is seriously eating into their share.
And the stock could react very negatively.
Precisely. And while the others, like Microsoft, Amazon, Google, are building their own chips integrating vertically, they are the ones footing the entire bill for this massive infrastructure build-out.
Amazon seems to be executing well on that front, though, turning capex into revenue growth, adding huge amounts of power capacity quickly.
Yes. Amazon added something like 3.8 gigawatts of power in just 12 months. That shows they can translate spending into operational scale.
But Meta's $100 billion capex guidance brings us back to that fundamental question. What does history tell us about these kinds of massive build-outs?
Right. And this might be the most important piece of context for investors to consider. We've seen this movie before. Huge spending on new infrastructure.
And the companies doing the spending don't always end up being the long-term winners. So the big fear is, are the Magnificent Seven just building these incredibly expensive digital railroads for someone else to profit from down the line?
That's the historical trap. Think railroads in the 1880s, telecom fiber in the 1990s. The companies funding the build-out. They often delivered pretty mediocre, even poor long-term returns for their shareholders.
Why'd that happen?
Because eventually, capacity often outstrips the initial demand. Competition floods in and prices get driven down dramatically. So who benefits? Usually it's the customers. They get cheap transportation, cheap bandwidth, cheap computing power. But the builders who took on the debt and the massive capex burden, they often struggle to earn back their cost of capital.
And the numbers needed to justify this build-out, the AI infrastructure, they seem daunting. What kind of revenue growth is actually required?
The math is, let's say, sobering. McKinsey ran some numbers. They estimate that to justify the maybe $5.2 trillion in cumulative AI investments expected over the next 5 years, These data centers would need to generate about $2 trillion in annual revenue by 2030.
$2 trillion a year from AI services by 2030. That's huge. How does that compare to where we are now?
Well, here's the reality check. It's been about 3 years since ChatGPT really kicked things off. Right now, estimates put actual AI-generated revenue at maybe $20 billion, give or take.
20 billion compared to a needed 2 trillion.
Yeah. The industry needs something like 100-fold growth from current levels just to cover the projected costs of the build-out.
That scale of growth needed. It helps explain some of the stranger things we're seeing, maybe, like this circular financing concept.
It could be a symptom of that pressure, circular financing. That sounds like a potential red flag, doesn't it?
It does. What is it exactly?
It's basically when a company, often a supplier, invests heavily in its own customers. Why? So those customers then have the money to buy the supplier's products. It can artificially inflate demand, make things look rosier than they are.
And we're seeing examples of that in the AI space.
There have been reports, yeah. Things like, say, NVIDIA investing billions in OpenAI, who then turns around and makes deals with other chip makers, maybe getting equity stakes in return. When capital starts flowing in circles like that, financing your own end market, it does raise questions about how sustainable the current demand really is.
Okay, let's try to balance this. We've laid out the risks. What's the core argument for these stocks? The bull case for the Magnificent Seven.
The main bull case still rests on those solid fundamentals we talked about earlier. Unlike 2000, these are not concept stocks. They have real earnings, real competitive moats. Think Microsoft's hold on enterprise software, Amazon's logistics and cloud scale. And they're still projected to grow earnings faster than the rest of the market, maybe 15% annually over the next couple of years versus 10% for the S&P 500 excluding them.
And maybe some regulatory tailwinds too, with the U.S. wanting to maintain leadership in AI.
That's part of the bull case, too, yes. A supportive environment, at least from a geopolitical perspective, wanting these companies to lead.
All right, now flip it. What are the biggest risks summarized? The core bear case.
Number one has to be the concentration risk itself. It's just systemic. If these 7 stocks stumble, even just a moderate correction, say 15–20%, the impact on anyone holding broad market index funds will be significant. It affects almost everyone.
Okay, concentration first. What else?
Second is that CapEx risk we've been discussing. The potential for overspending, building too much capacity too quickly, leading to margin compression down the road. We've seen that movie before.
Right, the historical parallel.
And third is valuation risk, especially for the highest flyers like NVIDIA. That high PE means there's just no room for error. If growth slows even slightly or competition really heats up, or if that $2 trillion annual revenue number starts to look unrealistic, the valuation could decompress quickly.
So, putting it all together for someone listening, if you're a U.S. equity investor, you almost certainly have exposure to these names just through index funds. It's unavoidable. Given all these risks, the concentration, the CapEx, the history, but also their real strengths, how should you think about positioning yourself?
Well, I think for the next, say, 12 to 24 months, a diversified approach probably makes the most sense. It's the safer bet. Own the Mag 7, sure, but maybe primarily through those broad-based index funds or ETFs. That helps mitigate the risk tied to any single company having issues.
So avoid being overly concentrated in just one or two of them.
Exactly. And if you do find yourself with very concentrated positions in one or two of these names, now might be a good time, given the strength we've seen, to consider trimming a bit, rebalance.
And maybe look for opportunities elsewhere.
Yeah, definitely look at the rest of the market. Valuations outside the Mag 7 are generally much more reasonable, potentially offering a better margin of safety. And earnings growth is actually picking up in some of those other sectors, too.
So the AI revolution, it's real. These companies are leading it, no doubt. But that gold rush analogy seems really apt here when thinking about investment strategy.
It really is the key takeaway for you to think about. In any gold rush, remember, it wasn't always the miners digging for gold who struck it rich long term. Sometimes it was the merchants selling the picks and shovels. And sometimes, ultimately, it was the people who benefited from the railroads that got built because of the rush. The AI build-out will create winners, but they might not all be the ones spending the trillions today. Position your portfolio accordingly.
See you all in the next Pro Ticker Deep Dive.